All right, guys. Hi. My name is Matthew, and I am doing exercise 8-11 up here we see. And so I'm right here in Wiley Plus. This is the actual problem. It says these transactions took place for Sky Song Incorporated. So they have a couple of transactions here, some from 2016 and one from 2017. And so we are here to put them in the journal. So on May 1st, they received a 3,300 12-month 7% note in exchange for an outstanding account receivable from R. Stoney. So you can think of this as before May 1st, we had an account receivable for R. Stoney for some product that we sold. So down here we see May 1st, the account receivable that before we had debited, we now have to credit to make room for a debit of this note receivable. So this note receivable then will be for the value of that 3,300, and then we credit accounts receivable of 3,300. Then we have on December 31st, accrued interest revenue on the Stoney note. And we see here that it was a 12-month note. We began May 1st. It's now December 31st, so you can count that up, and that is 8 months' time. And so we have, I can pull up my Excel sheet here. I have the calculations laid out. So we have to find our interest, we have the face value of the note times by the annual interest rate times by the time in terms of, in this case, 1 year. Well, it's always in terms of 1 year, but this time we're using months. So up here we have the face value, which is 3,300 times the 0.07, which is the 7% annual interest rate, times by the 8 months out of the 12 for the note. And that calculation gave me $154. So we put that in. Interest receivable is debited $154, while interest revenue is credited $154. So then 2017 rolls around, and it's May 1st, and we receive the principal plus the interest on the R. Stoney note. So we know first, probably it's best to put in the notes receivable here, because that is the principal, and we know that that is $3,300. So that will help us in figuring out the rest of our numbers. So we put that in here as a credit, $3,300. And then the interest receivable from December 31st, 2016 is also credited. So we put our $154 here. And then we have to calculate the interest that was that we earned from the rest of the months from December 31st, 2016 to May 1st, 2017. And I also have that here on my Excel sheet. So it's the same formula, 3,300 times the interest rate of 7%. This time we only have the 4 remaining months of the 12-month note. And so we plug that all in, and you'll get this $77 here. So we know that our interest revenue then will be $77. And then simply you add all of these up to know how much cash they paid. So the principal of $3,300 plus the interest receivable from the end of the year, December 31st, 2016, is $154. And then we add the $77 of interest revenue from December 31st, 2016 to May 1st, 2017. And you add all of these together, and that gives you your $3,531, which is the full amount of principal plus interest from the R. Stoney note. It was helpful for me. The link to the text here was helpful. There's no corresponding video for this specific problem, but if you scroll through here, this section, I should have had this pulled up. I thought I already did, but I didn't. Right here, it kind of gives you this same sort of a problem where you have to find the cash, the notes receivable, your interest receivable, and interest revenue. So it's just there in the link to the text. You have to scroll down a little bit, but it's the accrual of interest receivable. So that was helpful for me. Hopefully this video was helpful. Again, it's just simply plugging in the formulas that we have and plugging it all in right. Hopefully this is helpful, pretty straightforward. Definitely reach out with any questions or concerns that you have about my video. Thank you guys.